Most people shop for a mortgage loan like there's one obvious winner. But here's the reality. The pros and cons of the different loan options you're gonna have are gonna vary greatly depending on your personal situation, as well as what you're actually trying to do. So let's jump into why some of these loans might be better for you or worse for you, depending on your credit situation, how much money you have saved, and also what kind of income you might have. No one loan is a perfect fit for everybody. If it was, my job would be a lot easier and I'd just be able to tell you, hey, let's do this loan. So instead of giving you a cookie cutter answer, I'm gonna show you the pros and cons of these options, how they stack up against each other, depending on if you have good credit or if you have bad credit. I feel like credit score is kind of the delineator between which option makes more sense. If you have good credit, certain loans are a little better than others. And if you have bad credit, certain loans are better than others. So we're going to talk about both those scenarios so that whatever bucket you might find yourself in, at least you'll know what options you should actually be looking into or even asking about. Ultimately, the goal is for you to actually learn what might be a good loan option for you so you can avoid making a mistake that might cost you more money than it otherwise should, or even avoid going down a path in a certain loan type that might cause you to lose a prop. Really quick story before we get into all the different loan types and their pros and cons. A while back, this is actually one of my first clients. I helped them buy a property from their siblings. It was 3 brothers that owned it. Their father passed away, so they inherited the property. One of them lived in it. My borrower lived in it with his family. And so he was trying to buy the property so he didn't have to leave. He grew up there and he wanted to continue living there and he wanted to raise his family there. However, we did run into issues getting a conventional loan done. We kind of pigeonholed ourselves into a conventional loan for various reasons. So what ended up happening was we were actually having just kind of like a random conversation and he offhandedly mentioned that he served in the military. I immediately, light bulb went off in my head and I said, look, we got to look at VA now. When we flipped to VA, everything just worked. He was able to qualify for more. He was able to get a better interest rate. We were able to pay off all of his debt. We did all these crazy things to make this work. And he ended up being able to save tons of money buying a property because we were able to pay off all his debt. He was so happy. I'm so happy for him and his family. I still talk to them. One of the key things was we were stuck looking at a conventional loan when we could have been doing VA if we had actually asked the right questions up front. So the point of this video is to kind of get to the root of that. What should we be looking at so that we can actually determine what's the best for you and your family? So the first loan that most people know about is a conventional loan. The pros of a conventional loan really shine when you have good credit. In my opinion, if you have really good credit, conventional loan is going to beat most other options, especially if you have less than 20% down. In those scenarios, even though you have to pay for mortgage insurance, your good credit is actually going to lower the amount of mortgage insurance you have. And so when it comes to comparing a conventional loan to other options really, really start to pull away when your credit is, I want to say, less than perfect. If you're doing low down payment, the mortgage insurance can really start to creep up. And what I mean by less than perfect is basically anything less than 740. If you have less than 740, that tends to be, in my experience, where the other loan options actually start to even out. And then it just gets worse and worse from there on as you get lower and lower for a conventional loan. And just to put some numbers to it, if you had a low down payment conventional loan and you had perfect credit, your mortgage insurance might be $100 a month. If you have bad credit and I'm doing nothing but changing your credit score from a 760 to like a 640, now your mortgage insurance might be $400, $500, maybe even $600 a month, depending on a bunch of different factors. But purely the credit score is going to monumentally increase your mortgage insurance. And that's where you see the most impact in terms of monthly payment on your conventional loan when you have low credit. It's not so much the interest rate, although the interest rate will get worse in that scenario. But the bigger impact is going to be your mortgage insurance. So if you have low credit, but you're doing 20% down, now you don't have to worry about mortgage insurance. The impact is going to be less noticeable. One last thing that's really big now is all the different condos and all the different issues you might run into trying to buy a condo. Conventional tends to be a pretty streamlined option for getting a condo approved. The other loan types, we still have to get the condo approved in one way or another. A conventional loan, if you have enough down payment, really, you should be able to get most condos approved, at least in Hawaii. And if you have lower down payment, less than 10%, then it might be a little tougher, but it's still going to be easier than the other loan options. And that takes us into the next loan option, an FHA loan. This is the one that I love to use for people who have, again, less than perfect credit. Although if you have bad credit, this really starts to look like a good option. Back in 2023 or maybe 2022, the FHA actually reduced their mortgage insurance premiums. And when it comes to mortgage insurance on an FHA loan, you have to pay it no matter what. Now, the more down payment you put might lower the amount of time you're going to actually have to pay it, so it'll fall off eventually. But to start, you're going to always have mortgage insurance. The other downside, FHA, you have to pay for 2 different mortgage insurances. Whereas on the conventional loan, you only have to pay for 1. On an FHA loan, there is an upfront mortgage insurance premium you have to pay, and there is also a monthly mortgage insurance you have to pay. They stack up together. Now, where you see this start to even itself out with the conventional loan counterpart, even though you have to pay for those 2 different mortgage insurances, the difference on an FHA loan between like a 660 and a 720 credit score in terms of interest rate is very, very minimal. On a conventional loan, 20-point swings on your credit score could have an impact that you'll actually notice. This is why I mentioned up front, credit score is a pretty good delineator when we're talking about the different pros and cons, because your credit score is going to impact you differently on these different loans. And for FHA, your credit score is very minimal impact to your loan type. That's a good thing if you have bad credit. It's a bad thing if you have good credit, because you're not going to see much benefits for having better credit on an FHA loan. One other big, huge benefit that I love tapping into on an FHA loan, the amount of debt that you can carry if you're using an FHA loan is a lot higher than a conventional loan counterpart. That's not to say I want to put you in a home where you're stretching yourself to the limit, but there are situations where maybe we're not putting someone on a loan. Well, now we need to make the best situation out of just one borrower. And in that case, we're going to try to max them out as much as possible, because maybe there's this other income that we can't necessarily see that's not on the loan, but you nonetheless have it. So that's another consideration. FHA, you can stretch your dollar a lot farther and get more purchasing power because they allow you to carry more debt. One last thing that you have to be cognizant of when you're looking at FHA loans, they want to make sure the property's in good condition, and they also obviously want to make sure the condo is approvable per their guideline. And to get a condo FHA approved is actually pretty challenging. There's a few different options you have when you're trying to get a condo FHA approved, but they're all a lot slower than the conventional. So when you're buying a condo, you really have to have both options kind of in your back pocket, because let's say the FHA loan looks better for your situation. Well, if you can't get the condo approved and conventional is your only option, you might have to bite the bullet. But if you really want to buy that property, maybe that's the only way we can do it. Appraisals have actually gotten extremely standardized over the last 10 years or so. And so you're seeing a lot less discrepancy between which properties might be approvable from an appraisal standpoint on conventional versus FHA versus VA. However, there are still little things that FHA is concerned about that wouldn't be a problem on a conventional loan. So that's another thing to keep in mind too. The appraisal process can be a little stricter on the FHA side of things versus conventional. So now that we're done with conventional and FHA, let's look at the next loan option, which is a VA loan. The VA loan, in my opinion, is one of the best loans out there. 1, the interest rates are better than any other loan. 2, you can qualify for a lot more than any other loan. 3, you can get away, obviously, with less down payment than any other loan. You can get in a home with no money out of pocket. And 4, they have no loan limit for someone who has their full entitlement available to them. So it's a neat option for many people to actually come to Hawaii. Maybe they served in the military for a while. Maybe they were abroad and they're finally coming back home. They can actually buy a home, 0 down, qualify for a lot. Maybe they have a lot of family that's going to live with them, and I'm pushing the limit on their pre-approval. The monthly payment isn't even that bad because they're all contributing, right? Now, just to put some numbers to that so you can actually know what I'm talking about. If I pre-approved you for, hypothetically speaking, a $500,000 conventional loan, if I do nothing else but flip the loan type to VA, I could probably push you up to $700,000, maybe even $800,000. Now, there are still downsides on a VA loan. The one that is not really a downside, but it is one nonetheless, a requirement that you cannot avoid, is that it is owner-occupant only. Now, that owner-occupancy requirement is actually pretty lenient. You can actually live there for just 1 year, and then you're good to go. So if you can commit to that at least, then you're set. The other downside that's, I guess, pretty obvious, but it should be mentioned, you actually have to be eligible for a VA loan. Not everyone can do it. It's a loan that's intended for our service members and veterans. We can get your certificate of eligibility if you're unsure. Non-military service members or non-veterans are not eligible. Last thing about VA that I want to mention, I said this on the FHA side of things, that the appraisals can be a little nitpicky. VA is also the same, where they nitpick on certain things. They're really big on not having chip paint on anything in the property. They're also really big on not having torn screens, open windows. I've seen a leaky hose bib outside be a problem. We needed to fix that before we could close. So they're nitpicky on kind of the little things that you wouldn't normally think are issues. Like you could live there and deal with that yourself. But before we close, if those problems are there, I've had agents go out and fix it themselves, bring a handyman, paint the chip paint, fix it up. So it's not really that big of an issue, but it is worth mentioning because some people think, oh, a VA loan, you're not going to be able to do the loan on this property because it's not in perfect condition. It doesn't need to be in perfect condition. It just needs to be livable, and then those little things need to be fixed. Now, the last loan that I have for you is a USDA loan. Now, the pros of this loan is that it's 0 down. I could get you into a property with no money out of pocket using a USDA loan. So that's a really nice benefit. I think it's a fantastic option for people who are limiting their budget And here's why. When you do a USDA loan, we actually have to qualify you for it. And the qualification for a USDA loan has much stricter debt to income ratio requirements. What I mean by that, and what it boils down to, is that if I pre-approved you for a conventional loan at, let's say, $500,000, just flipping to USDA, your purchasing power is going to go down to maybe $300,000 or $350,000, purely because the way they look at your income and how your debts stack up against it. So one big drawback of a USDA loan is the qualification is much stricter. One benefit of a USDA loan is that the rates tend to be a little better. They're pretty comparable to a VA loan. And what we can do is we can say, okay, if we're doing USDA versus conventional, but keeping the purchase price the same, the USDA loan is going to have a better monthly payment because the interest rate is a little better. Now, conventional could be better if you're putting a large down payment. And that goes into one of the drawbacks of a USDA loan. If you have 20% of your purchase price of the new property in funds, in liquid funds, you are no longer eligible for a USDA loan. That's one of the checks we have to do. Now, if you have retirement, that's another thing. They don't care about your retirement accounts. It's really just liquid funds available, right? So investment accounts, checking and savings. The other drawback is a USDA loan does have geographic restrictions. And so you can't use it everywhere on the island. If we're imagining Oahu, what I like to tell people is imagine H1 and you're going west. You start at Waikele. Everything west of that and north is eligible. Then you have to subtract out Waipahu from that, which is south of on the southern side of H1 of Waikele. Now from the north side all the way to the east side, you have to subtract out Hawaii Kai and you have to subtract out Kailua. Those two areas are not eligible. And you also have to subtract out a good chunk of Kaneohe as well. When you're imagining the east side though, if you're driving down Kahikili Highway, and you hit Haiku Road, which is the road right before you go down the valley to get to Kahalu, that road is the dividing line. And then you go to Kahalu, all the way up, all of that is eligible for USDA. Now, if you're looking at North Shore and you're coming down towards central part of the island, everything from the North Shore down to Wahiawa is eligible. Some of Waipio is eligible, none of Mililani is eligible. And so I'm telling you these areas that are USDA eligible, and the USDA loan, technically speaking, is a rural loan. And that's because they do the eligibility based on the population density. So every time the census updates, you may have some areas that get added or some that get removed. The other last drawback of the USDA loan is that it does have an income limit. Admittedly, the income limit is fairly generous. I have never met someone that wanted a USDA loan that couldn't get it because of the income limit. So I wouldn't worry about that one so much. The bigger concerns you have to have when you're looking at USDA, it's tougher to qualify for, meaning your purchasing power is going to be a lot less on a USDA loan, and there are geographic restrictions. So what's the best loan? Here's the twist. It depends entirely on you. Here's the mental flow chart that I like to use when I'm trying to figure out which options to pursue first for the clients that come to me that want to get pre-approved. At the top of the flow chart, I like to ask, are you eligible for a VA loan? If you're eligible, chances are the VA loan is going to be the best option for you for the variety of reasons we mentioned up front. Now, if you're not VA eligible, but you have really good credit, conventional probably is going to be the best bet for you. If you don't have really good credit, then we look at FHA. Because FHA, when you have less than perfect credit, the numbers really start to look a lot better. Lastly, USDA, I pretty much only bring that up to clients who are pre-approved for a lot, but they want to limit their budget for whatever reason. So if I pre-approve them and I say, hey, I think you can afford a $4,000 a month payment, but they say they only want to stay at $2,500 or $2,000 a month, that's when I would bring up USDA, because we know that I can get you pre-approved for that amount, roughly speaking, and you can get into the home with, a lower interest rate and no down payment. So that's the flow chart. If you want to see what this would look like for you specifically, if you want to dial in your income, your credit, how much savings you have, stack up all the options side by side, go over individual scenarios, pros and cons for them for your specific scenario, schedule a consultation with me. The link is in my description. It'll take you directly to my calendar and you can see exactly what my availability is. If you're feeling more motivated and you just want to get pre-approved already because you kind of have an idea of what option you want to do, there's also a link to my loan application in the description. Just go ahead and get started by clicking there. I'll be notified the moment you start the loan application and the moment you finish it, and I'll review it within 24 hours and we can talk about your situation. Thank you so much for watching. I really appreciate your time. I'll see you in the next one.